Hello, ladies and gentlemen, and welcome back. Well, we're at the zone, the 200-day moving average. We've got some stats about what's happened so far in 2023 that might surprise you. But more importantly, we finally see relief from brutal selling in the last couple of days. Zero-day options expirations are no doubt taking their toll. But what's more interesting is not just this candle, but what was moving bullish during the session. Is it something that Wall Street's setting the trap for? Let's take a look right now together at all of the hottest markets around the world. Well, welcome back everybody to the Daily Show. We've got the news, macro, lead indicators, and the hottest charts. But let's begin with the S&P 500 and the 200-day moving average. We've got some crazy stats here in some ways about what happens when we get these reads. If we have 18 days above the 200-day moving average after a 20% decline, well, the next week to 2 weeks can be a bit shady, but overall, the stats are pretty bullish. You can say that 100% of the time, 3 months later in the previous reads, which most importantly come off some of the significant lows, have been very good. Now, we know that markets are being set to trap people, though, this year. In 2022, we got a lot of thrust and breadth readings that even have led us to where we are right now in the markets. They also tended to lead us out of recessionary style periods. But here's the problem, and it's still the problem. Inflation and, of course, interest rates. Here's a bit of an update just on the charts. We're almost hitting a 5.5% Fed terminal rate now. Some people believe that's going to go to 6%. If it does, expect further market downs and further market delays. But more importantly, the market's coming around to this idea as of March that we're going to be higher for longer. Could that mean that we're in stagflation and we don't even know it yet? If that's true, gold bulls might have to come back very, very soon. Let's look at some of the other things that are going on, though, under the hood, and we'll take a look at everything we've got right now. Smart money versus dumb money. What's going on there? Well, smart money kind of resumed purchasing recently. They've kind of flatlined the last 24 hours, and dumb money is kind of flatlining here. No one really is clearly agreeing on this 200-day moving average. But here's where I think the stats are getting a little bit weird and super strange towards the bear side. If we were going to see a sustained, really heavy sell-off, generally the market will turn defensive. That is not what we've seen recently during the sell-off. We've actually seen defensives underperform and offensives perform better as a comparison ratio in the decline. This is not what you usually think of when you're thinking of, okay, a market that isn't going to rally again. But don't worry, the last 24 hours may have changed that. So here's a very arbitrary number, but basically it just shows you the S&P 500 after the 3-month lows for staples is greater than 35%, but of course discretionary is less than 16%. Now I want to point out two levels here. Before the crash of 2001 and before, of course, the GFC or during the GFC crash, those two readings turned really bad. But of course, we also know that still the next month or 2 months, even after these readings, were bullish. So does that play into this idea that March might start bad, sell off, e.g. this, then increase, then we see a brutalized sell-off later on in the year? Well, we could be in those types of numbers. Here's some other stats around when we see utilities get hit as much as it was. And of course, this is after the percentage of 1 month lows for the utility sector exceeds 90%. And again, S&P 500 performed okay after that. What it's telling you is that the market theoretically is moving out of defensives and moving into, again, growth stocks with their cash. But I do think that it might be a little bit premature to say that, and we've got some stats on it a little bit later on. We won't go too much into this, but many people want to explain why markets are up so much. Here's the American consumer still spending out of control. Here's the problem, the debt. This will eventually come back as an issue because we have higher interest rates for longer, and this debt's going to need to be financed on it. It's a component of why I believe markets are up. But really, it's this one here. Now, we will be following this story. I know I've used this chart quite a few times, and it just points towards liquidity increases from the big six. These are the central banks around the world. Now, in the last 2 to 3 weeks, that has dropped off, and guess what? Markets have dropped with it. I'll be telling you here on the channel if I've got indications that liquidity is increasing. Usually it's delayed, so just remember that. But remember to subscribe and smash that like button if you're interested in that one. I will be following it and following that story closely in 2023. At the moment, the markets are following the non-recession path. Keep that in mind. I still believe there is a recession coming for the US. It's not really my opinion. It's the opinion of the bonds market. In a subsequent video follow-up, maybe on the weekend, we'll cover why the bonds market's telling us that a recession is coming. But remember, at least one of the reads that we need to see increase is unemployment. That hasn't happened according to the jobs numbers. Guess what we've got next week, guys? The jobs numbers are coming out for the US again. So be on the prowl. Make sure you start watching those things. We also know that the Fed increasing interest rates as fast as they have done has always broken something. In a previous video, I asked you what you thought. Quite a few people got what I think it is, which is zombie companies. I think zombie companies are kind of like the black swan here in the economies around the world, especially Western economies. So many dead businesses that have been supported by Federal Reserve liquidity over the last couple of years. As that dries up, theoretically, pressure could be put on. So to stop inflation may end up cracking the zombie companies. We'll find out soon. I thought they would have maybe gone in 2020, but of course they didn't because the injection. What about this time? What about when things really do get potentially tight in the economies? What's going to happen? Let's talk about Fed liquidity and the seasonality. So far, we saw kind of Fed liquidity or central bank liquidity start dropping around this period of time. A few weeks later, obviously mid-Feb was where we dropped based on also seasonality. Where do we find ourselves right now? Well, funnily enough, we've just seen a recovery. So we kind of find ourselves here at the 3rd of March, which is pretty hilarious. Do we get a bit of a blistering sell-off coming through? Well, we'll find out. But of course, March, the start of it into around the middle often is weak. And then we tend to get these really good back-end March into April rallies. Will we have it again? Q1, Q3, the most volatile times of the year. We've mentioned it many, many times before. But I want to get into this chart, the last 24 hours. So the rally we deserved, 6 to 7 days down in a row. Every single time the market was up, it sold off. And this time it started down and it bought up. Yeah, the futures are pretty hilarious. It almost goes the exact opposite way of what the futures have been doing each day. But look at this, utilities and staples. These are the two defensive sectors. They're out in front. So definitely be paying attention to this. We'll be following the story. It doesn't change really the last 5 days. We've seen inflation-based, stagflation-based kind of stocks doing a little bit better. But utilities is now made a big inroad increase. We'll actually look at the chart when we get into the charts very soon to have a look at this, because utilities is a sector that should theoretically get fired up right now at around this point in March. And did it just do a final kind of dump to scare everybody out of it? Well, we've got the charts very, very soon. So just before we jump into the charts and we take a look at all the key levels that you should be watching right now, I wanted to say a big thank you to the sponsor of today's video, which is Tiger Brokers. Now, I'm sure you're all familiar with order books and bid and ask, but what's happening right now in the markets might have you a little bit confused. 0-day options expirations are here to stay. And what that means is that markets are faster than they've ever been before. So with being fast, you need to have fast tools. Well, luckily, Tiger Brokers have introduced ladder trading. This allows you to put in quantities and preset kind of techniques and then trade directly off the tape here on the ladder. If you want to buy 10 units or whatever your preset was, it's as simple as clicking on it, pressing confirm, and you'll go in the system instantaneously. If you need to sell something very quickly, you can do that right off the tape. Select the price, know which price is moving, and also see it going as you're like literally trading it. This is something that's very important nowadays because you need to be as fast as almost like an algorithm in the markets right now. If you're interested in some of these features and some of the other features that Tiger Brokers offers, remember there are a bunch of special offers in the links down below. If you fund with as little as 1 cent, especially if you're from Australia, there's a bunch of extra special things that you get and some additional Microsoft stock. As you guys know, I do love that stock. So don't delay, check them out down in the description below if you're interested in some of their features and all of the other great stuff that they've got on the platform. All right, well, let's get into it. Let's get started with these key levels. First up, yields. We've seen 2-year yields go above the key levels. I expect it to kind of hover around here. We do have some economic news, but we've got jobs numbers coming out next week and some other information. That most likely will really push yields in whichever direction. We did see an increase in high yield junk bonds. So this is something that was probably hand in hand with the rally in markets. It's not sustained. So we haven't seen junk bonds realistically find strong buyers, but something that we're watching. TLT dropped back down, actually made a new low. Perfect. It's coming into that really nice kind of 61.8 fib. Now, TLT hates increasing yields. So if we start seeing decreasing, what's going to happen? TLT will, of course, do better. It's that medium term, though, that's really hurting treasuries right now. The fact that we're going from a high terminal rate to less cuts for longer. And that's what treasuries are not doing so well off. When we move over to the US dollar, it loves increasing interest rates, so it makes sense that it was bouncing back up. It's still in a 2-hour, remember, and 4-hour upward trend. So we've made it back to this 105 kind of 13 level, and we've tapped what we previously saw as a sell-off zone. This is basically now supply, and that's what it's tapped, and you can see these rejection wicks. If you're still feeling bullish dollar, though, we've got some great reaction zones that we'll be watching, and you will see how fast and how good these reaction zones could be for you and your trading if you're a little bit of a dirty scalper out there or a day trader and you really know how to play these zones. So here are some wick rejections, and of course we're looking towards, at this point, if you're a bull, markets closing above this. If that happens, expect a new high, and that wouldn't be bad because we're kind of at a point where we expect consolidation. So if we saw a new higher high, then we saw a lower low, at this point here, should that breach through, we'd be able to basically say, okay, it looks like the dollar index is over. In our previous video, we talked about how the DXY may not have as much legs in it left as people think, but it's at these critical levels. I love this supply up here. I'm really interested to see how the market reacts, and I would still like to see DXY come through with the goods for a little bit longer. Let's move over to gold. It's holding uncharacteristically high. I believe it's a stagflation kind of concept by the street that's probably doing this. I think it's too early to tell. Obviously, we have a supply zone. We've tested it. I'm looking in the next 24 hours for a new high to be formed, and then for it to breach below what we now know is a pretty key level, 1830. So I'd like to see a higher high and then a lower low. At that point, we're looking towards further selling of gold. But at this stage, yeah, I mean, it's done its little job. I mean, if you look here on a daily, it's moved around. It doesn't look super negative anymore, but the 2-hour trend is still down until we breach through this supply. So just remember that. Trend's technically your friend. Sometimes it's going to fail you, but realistically, it's better to be in the direction of trend than not. Let's move over to copper. Took a bit of a bath in the last 24 hours, which is good. And we need copper to continue to weaken. At this stage, it's kind of in limbo land. It's finding some buyers, but it's at a critical zone. I'd like to see copper, even if it does rally, find instantaneous shorting. And of course, if we move back below 390, I believe we're moving towards 370, which shows us probably a sickness in the economy. So we'll keep watching that one. Natural gas, 2 days ago, we had a great video on this with some pretty amazing stats that showed some pretty wild stuff. Similar to this time, we saw a contract roll. Now, remember, it's the widowmaker. There's risk. There's risk in the ETFs. The ETFs are actually mostly futures contracts. So you've got to be very, very careful here of what's going on. I do still expect a drop followed by a potential of a rally. I mean, the data stats are very, very good there, but it does look like natural gas may have bottomed for now. That doesn't mean that it's just going to keep rallying. It just means that it's in that kind of bottoming process, let's hope. Let's move over to Tesla. So it was a pretty brutal day. Investor day didn't really work out. Buy the rumor, sell the fact. But we've come back down to some pretty critical zones, and we found some buyers near the end of the session. Now, this is good for Tesla, but is this part of a distribution wyckoff? Well, let's look at the evidence. We have the buyer's climax. We have a potential UTAD or UT. We have an island reversal now because, of course, it gapped up and it gapped back down. So if we rally, you have to kind of think sellers may be here on Tesla now. The evidence points towards nastiness. And if it is nasty, and let's say the markets do end up tipping over here in the beginning of March, could we see a brutalized sell-off on Tesla that forces us back down to fill this gap? So fill the gap that sits around 140 to 150. I think it's possible. This is still looking like it could be distribution. Obviously, you need another follow through to really push that narrative and that idea. But yeah, Tesla is starting to look a little bit weak here after the fact. Why is that? Well, it's too many people getting bullish on the concept of, oh, look at these amazing things happen. Don't buy the storyline, guys. Buying the storyline's lame. It never worked during Apple for about a decade. Generally speaking, buying the story sounds good and sounds plausible, but most of the move on Tesla happened when people least expected it, yeah? Just remember that and keep that in the back of your mind when you're looking at charts. You've got to be looking at what happened before. What's the storyline of the charts? It's such a big thing. You know, to change my trading over history, the way I looked at it is I started reading the story of the charts better. And the story was basically human psychology. So when you stack the charts, the technical analysis, the price action, and the human psychology together, you'll start to make a little bit better decisions. Here's one that was a little bit surprising, and that was NVIDIA. Held up better than you would think, but at least it's still kind of creating this island. Now, if NVIDIA opens with a big gap low, and it kind of opens like here, gap down, that will therefore be an island reversal, which would be good. And then you should see it fill into 207. At the moment, this is all being held up by AI, and any day that's bullish is being allowed to be cracked by NVIDIA. It reminds me a bit of AMC and GME and any other stock when you usually have these on it. If you're a bear on these are actually ones that are hard to predict because you're going against so many retail FOMOers and you have to be able to hold in there. So timing will be your friend there. Let's move over to Intel, a bit of an X factor kind of stock here. I just noticed it's starting to base off. Volume's been up recently, and I was looking for it to swing these lows and then seeing how the reaction was. Now, Intel has been an absolutely terrible stock. Not saying this thing's been good. I mean, you put it in weekly, it's absolutely terrible. But it's interesting to see it's doing its own thing completely separately to the rest of the market, and obviously volume is up. So I would assume that somebody believes its value here and other people think it's terrible. We'll find out. Let's now move over to utilities. So utilities has been brutalized. I mean, look at this, 2023 from the 9th of January. If you bought utilities rather than the market, yeah, you're down pretty hard. And actually, let me put that in perspective here. From this to here, you're down 9.81 from the low 11.92. So it's come back to a level that I suspected it may do so. And this is kind of like an extreme low swing. Now, we see the daily, it engulfed backwards against that. This also has some pretty big volume in it. So utilities is being traded right now. And traditionally, this has been a very interesting time for it. So I would like to see utilities now find buyers, and it kind of needs to stabilize and find buyers right now. It's the time that it should do it, theoretically, if March is going to get a little bit nasty. Let's find out whether it does. Same thing on staples at this point. Let's move over to US 30. We've got demand here, and you can see that it's holding up as best it can. So maybe alerts underneath these lows for the Dow. If the Dow falls underneath, then of course you know that the big kahunas have started to fall through. We'll move over to the Australian market for the Australian audience out there. Nothing much. I still think this thing is going further lower. It's being buoyed mostly by BHP and Rio at the moment. So yeah, if the US market falls over, expect Australia to underperform at the moment based on, of course, the copper potential drop-off that we may see in March. So at this stage, XJO, it's on the trend line. That's the best case scenario for the bulls, and we're getting close to those kind of critical levels. All right, let's move over to the Nasdaq. Now, we had a watch reaction level, which we seldom hit these, but when we did hit it, we watched the reaction, and I can tell you if you're looking at the 2 hour, it looks pretty damn good towards the bull for the session. You can see here a lot of rejection wicks coming off the watch reaction level. So clearly the market liked this zone. It said, okay, enough is enough. We've pushed too far down. We've got to come back up to fill some gaps that are up above here, and we're going to begin a bit of a rally. So they allowed a rally to come through. To put it in perspective of the Qs, let's have a quick look. It also came back to the 61.8 of the last swing. So we kind of have one swing, two swings, 61.8 fib, and then we saw some buying. It's been mostly brutalized in recent days and pretty much the last 2 weeks. So it's a little bit of relief at the lows. Why else could this have happened? Well, it's got to do with the 200-day moving average. Obviously, that can act as what we call dynamic support or resistance. In this case, it was dynamic support as we're testing it from the top down. This is not really unexpected. I mean, we had 1, 2, 3, 4, 5, 6, 7 days in a row down where it was always like rally into the start of the day and then we dump through the session. and we finally see one green candle. Now, some people will say, wow, that's bullish. Look at us go. Well, let's have a look now at the futures market and check it out. So here are our two main supply zones. We've got just underneath 4,000, which we know is supply because we've seen it tested a lot. Where did we tap into in the last 24 hours? Exactly that level. So I'm looking at, do we see maybe a new high, low switch, something like this in the next 24 hours in the markets leading into the Friday expiration? This is pretty much working perfectly into the options expiration and Wall Street's hands. And we'll look at that very soon. But we've got a mini supply here. We've got a major supply here. And again, above 40.27, we have to expect the dips will be purchased and 40.80, 40.90 becomes the real deal. If we get it below, or if we can come back into the 390, 380, 3890, then we might expect buyers. So that's where we see probably the stronger buyer lines. And we've got the major confluence areas back down here. So that's 38.43, 38.29. Just underneath that as well, there's a bunch of gap fills. There's so much to like about down here, should we get there from Wall Street's perspective or the composite man's perspective. But the immediate dangers are bearish because of this supply and this supply. These two zones are most likely where bears hang out in the markets. You just need to see them reacting to it. We've seen the initial reaction to this supply. Will we get another pump into a dump? If we do, well, next up could be 3,900, 38.90. Let's see if that makes sense to the options side of things. Here's the SPY. Here's, of course, the previous session. Let's have a look at the third level. And you'll notice there's a lot of 400 calls, so unlikely for us to want to go through that. Actually, they're pretty new, those 400 calls. We didn't have 74,400 calls. 0-day options expiration. Yeah, look at them coming out. We're going to have to go to daily maximum pains now. 74,000 calls sitting at 400. And of course, 390 being 65,000 puts. What would Wall Street like? Well, if we can end kind of in between both of those, that's A-OK by them. Max pains technically 398. So on this top end, but realistically anywhere between these two zones, this 10 points on the SPY would be absolutely fine. And it's funny how they manage to do this all the time, isn't it? They're sneaky, sneaky. When we're talking about news for the day, we've got ISM services PMI, but I want to just quickly fast forward into next week so you're aware of some of the news that's coming out. We've got the Fed Chair Powell being annoying on Wednesday, March 8th. Then we scroll through. We've got some other monetary policy statements coming out from Japan, which could move some markets, especially currencies. And then we come out with the big guns. We've got the unemployment numbers. I do think a lot of people will be looking at non-farms this next week. That's going to be quite important. We'll move over to our final chart here, which is Bitcoin. Let's take a look at Bitcoin. Nothing to really report here that's exciting. Our watch reaction levels, I would certainly have them as alerts. We already know what happened up on this one. The bears got control. It was pretty obvious, and they've kind of shorted it off. Here, Bitcoin is being held by probably Chinese stimulus. So that's the bank stimulus that's coming out of China at the moment. At this point, though, it's maybe got some catch up to do. A lot of people will see this as a flag on Bitcoin. And if we actually proof the flag, so let's use the trend line here, and we proof that flag. So some people will proof it like this. Generally speaking, you'll do that. It kind of proofs into this buying area. It's not really what I would call amazing. But yeah, basically Bitcoin doesn't really look strong at the moment on the charts. It looks mostly weak. If you haven't already, check out Tiger Brokers, the sponsor of today's video. Links in the description down below. Also, come and check us out on some of our other socials. Links in the description as well down below. Subscribe, smash that like button, and hopefully you enjoyed today's video and got some value out of it. Thanks so much, guys. You have a great day. We'll see you in the next one. Bye for now.